Hi, everyone. Welcome to the TimingResearch.com Crowd Forecast News, episode number 294 for March 22nd, 2021. We are recording this at 1 p.m. Eastern Time. My name is David Cosmeter. I'm the creator of TimingResearch.com, and you should be seeing my screen right now. I'm going to pull up some charts as we talk about the markets today. And today I've arranged for Sam Bourgi of TradingGods.net to be our guest, and the option professor of optionprofessor.com is the moderator again. So I'm going to go ahead and turn it over to him.
Okay, great, David. Thanks a lot. And welcome everybody to the meeting here this morning. What a morning it's been. If you got up early and did some buying, you've got some stuff to talk about already today. With us again is Sam Bourgi of TradingGods.net. And Sam, for the people who are not familiar with you, could you give a quick background on yourself and also a quick background on what's going on at TradingGods.net?
Absolutely. Hi, everyone. Thanks again for having me. It's always exciting to be on. My name is Sam Bourgi. I'm the markets editor for TradingGods.net. And at Trading Guards, our goal is to essentially help traders access the markets through our retirement day trader program, which is all about selling weekly options and accessing the CBOE VIX volatility markets. My background's in economics and policy. I've written a lot about the financial markets, cryptocurrency, and the commodity markets over the past several years. Looking forward to getting started.
Sure. Okay. Basically, there's three questions that are asked on the show. And we're going to start out with the first one. And this is just the best guess, obviously. From today's opening to Friday's close, what's your best guess on what the S&P might be doing this week?
I believe the S&P will finish the week higher. So that's the first answer. I don't know if you want me to elaborate on that yet, or just go through the questions.
No, yeah. So that's the answer on that. And then the second thing we were going to talk about is your confidence level. 100%, 50%.
I've been doing this show for a few years.
Yeah.
I can't go more than 60 to 70% confidence, maybe 65% confidence.
Yeah, more confident than not. In other words, more likely than not that it's going to go up. That kind of thing. Well, the main thing also is what's behind your reasoning. Things that you're watching fundamentally, technically, that are telling you
basically,
that.
I still see the market as being in an uptrend, and I see the stimulus checks coming in, and that usually means that the markets are going higher. So I don't really see any reason there should be any kind of sustained pullback. I know we've seen some rocky conditions the past few weeks, but I look at the VIX, the CBOE VIX, and I see it right around the historical average, which typically when stocks are near record highs or at record highs, the VIX is usually much lower. But all things considered, the way the market has evolved since the COVID flash crash, seeing the VIX at around 20, for me, is indicative of a market in complacency, and I still see there being an uptrend in stocks. So the least resistant path, I think, is higher. So that would be my reasoning.
Do you think this end of month rebalancing would be favorable to something or another?
Yeah, I think so, and I've seen how the VIX has responded over the past few weeks, and I just see, looking at it as a macro perspective, you look at where the VIX is and how it relates to the S&P 500. I don't really have much choice but to say that the S&P is continuing higher. So that's just the way that I read the VIX and how it relates to the broader market. And then you have the macro factor, the fundamentals on the stimulus front, and then you got Powell this week as well, who's probably going to talk up the market and maybe ease some concerns around interest rates. So yeah, that's my general view of things.
If we get this pause in interest rates, which we obviously are having already today, if that were to continue, do you see the NASDAQ or the semiconductor index? Do you follow things like the SMH semiconductor index or the QQQs, the NASDAQ index?
Yeah, I follow the NASDAQ. I know the NASDAQ has had some pretty wild moves lately, but yeah, I think that a lot of the recent volatility has been around the bond market and concerns about inflation and things like that. I think that if the Fed steps in like it always does, I don't see a reason why we're not going to see a rebound in the NASDAQ, probably back toward record highs, right?
Yeah, well, I mean, I think at least you have a decent line in the sand with the lows this month, and you could trade accordingly from there. And today it's obviously off to the races pretty good, but it might have been a situation where people are going to get caught leaning out of growth and out of the NASDAQ. And as we go into the end of the month, maybe there'll be a more rebalancing thing going on there. So it'll be interesting. Apple's up over 3 points today. So it looks like somebody's starting to come back into tech and come back into the semiconductors pretty much. With regards to the VIX, it's been hesitant to get under 20 and stay there. If we were to break the 20 and start seeing 18 or 17 on the VIX, that would pretty much cement the idea that we're going towards 4,000 on the S&P, don't you?
I think that would be a foregone conclusion at that point. I mean, the S&P and the VIX move inversely with one another about 75 to 80% of the time. So it really is a good indicator of where equities could be heading over the next 30 days. And I mean, I've been covering the VIX for 5 or 6 years. Typically, when stocks are this high or when they're so close to record highs, the VIX is usually much, much lower than it is now. Obviously, things have changed. Now that the fact that the VIX is below 20, that's very favorable for stocks. And as you said, if we hit 18 or below, that more or less cements another uptrend in stocks that I think another record high would be absolutely imminent. That's just the way the market has behaved relative to the VIX. And I mean, during the Trump administration, we saw VIX around 10 or 11, even lower at some points. So obviously things have changed, but considering the macro backdrop, the response to COVID-19 and everything, I think that a VIX of 18 is very good in terms of overall market sentiment.
Yeah. A lot of people think that the VIX, should really not be this elevated, based on how the prices are going and how the economy is going. So if we were to get a stampede of buying off that sideline money, because there's quite a bit of sideline money, right?
Oh, absolutely, absolutely.
And they're going to get tired of that zero interest in the bank, and so people get more confident as things go higher, and then of course sometimes they live to regret that. But that's just the fact of life. People go with the winners.
Well, that's what I've been following with Bitcoin as well. I mean, people find it a lot more enticing at 50,000 than they did back at 6,000 or 7,000. So it's just part of human psychology, and I think that it's the same thing for the equity market. The higher it goes, the more it seems to attract a buying interest.
Bitcoin, what's your feeling on how to possibly get involved with that? I mean, my feeling has been you wait for the 30 and 50% drops and then you take a shot, and then you try to let it ride and then wait for that other drop, because it does seem to have 30 to 50% drops quite often.
Oh, absolutely. And I know every time I'm on, I always seem to hijack this into a cryptocurrency conversation or a Bitcoin conversation. Although every time it seems like the narrative surrounding it is stronger and there's more institutions involved. But yeah, absolutely. Bitcoin is still a highly, highly volatile asset. Seeing 20-30% drops in a bull market is very, very common. Sometimes up to 40% in a bull market, it's very common. So that's one way you can enter the market, is through waiting for those large dips. Obviously, I mean, you don't always get the dip that you expect. I mean, once Bitcoin hit 20, I was expecting a retracement back down to like 14, 15. That never happened. It just kept going up and up and up. So obviously the dollar cost averaging aspect is always important. I mean, it's at 56, 57 right now. Depending on which theory you follow, it could still do another 4x from here, and that's in a very short term. That's if Bitcoin does what it's done the past cycles. I know that sounds crazy looking at it as 57 and thinking that it could still do a 4x, but when you compare it to previous cycles and you compare it to the fact that it's a deflationary monetary policy, it actually is possible. But then again, it also moves in 4-year cycles, so I don't see any reason why it's not going to have another major correction after this cycle, followed by a pretty long bear market. So there's always going to be opportunities to get in, but how low do you want to go? I'm not sure it's going to hit those lows that we saw previously again, but it depends on whether we've seen a new line in the sand, as you mentioned earlier. I think that we have, but it's still highly volatile, and you don't want to just enter without doing your due diligence.
Yeah, the two things that are on my mind with it, because I've been using GBTC as the vehicle of choice.
Yep.
And basically, the two things though that are concerning is 95% of the supply of Bitcoin is controlled by 2% of the accounts, which means you got a liquidity issue that will not go away. And number two is that competition could come into this thing, and somebody could create another, or I'm asking, could somebody create like a government, like the US government or somebody come in and create a new digital currency, and then people wouldn't want any part of this because they would be more interested in the one that's maybe backed with more transparency? I don't know.
Yeah, those are good questions. When it comes to GBTC, that is a legitimate concern. I mean, I've been following Grayscale for a while, and I guess the bullish side of that argument is the fact that Grayscale continues to add Bitcoin at a pretty significant pace. And you can go back and look at their assets under management the past few years; it continues to grow. But that is a concern. In terms of the Fed coin, I know Powell talked about it, a central bank digital currency today, and that how they're not in a rush to implement one. I don't believe that that will have much of an impact on Bitcoin in the long run, because Bitcoin, its principles are significantly different than the fiat money that the Federal Reserve creates. So whether you put the dollar on a blockchain, in my opinion, it's probably not going to have much of an impact on Bitcoin being a potentially a safe haven asset. I mean, we're definitely seeing that now. There seems to be some indication that some of the market cap is going away from gold and into Bitcoin. We can't say that definitively now, but there have been some pretty credible analysts from Bloomberg to even BlackRock that have noticed this trend of capital being siphoned away, possibly from gold into Bitcoin. So I think that the narrative around Bitcoin is different, but I think that central bank digital currencies are a foregone conclusion. I think they will happen. There's other countries around the world that are much more evolved in terms of their where they are in the development. I know China is. They've already piloted their digital yuan. And I think it's only a matter of time before the U.S. is the same.
Yeah, it seems to me that China and other countries may want to have a digital currency. Of course, all the developing countries want to have it because their local currencies are a joke.
Mhm.
And so they wanted to have something to barter with that is not controlled by corrupt governments or something like that, right?
Yeah, absolutely. And you're even seeing right now in like places, especially in Africa, I mean, Bitcoin use is skyrocketing. You look at Nigeria as well. So there definitely is demand for that digital currency. Whether they can escape a lot of the issues of their existing national fiat currencies by digitizing it is yet to be seen. I don't know the answer to that, but it's definitely in development. It's definitely something that is coming. And I think that we're going to start seeing more development on the next 2 to 3 years.
With Tesla, one of the things they had going is obviously they were first in the electric vehicle with size. And so one of the risks to Tesla would be that competition comes in and, they've had to drop prices in Japan substantially. So if their margins go out the window and their market share goes out the window, there's a risk to Tesla longer term. But some say that because the market is going to be so big on electric vehicles, there's plenty of room for competition. Would you say that in Bitcoin, obviously, if a competitor of size came in, they're not priced for that, but a digital currency market may be so tremendously large that there's room for more than one player?
That's a really good question. Well, I mean, one of the main criticisms of Bitcoin in the past was that anybody can fork it and create their own alternative. There are over 8,000 cryptocurrencies on the market today, many cryptocurrencies, but none of them have been able to do what Bitcoin has done. None of them have had the adoption. According to some estimates, there's maybe 100 million Bitcoin users around the world. I think the market for digital currencies is here to stay. I think it's a new paradigm. I think it's a new financial asset. So in that respect, I think Bitcoin is always going to have um, a market because it's demonstrated itself as a potential store of value. And if you actually look at the numbers, it's possibly the best performing store of value of all time. If you go back and you take a look at how it's done since 2010, there's a lot of other cryptocurrencies that are on the market. Ethereum, for example, is a huge one. And in fact, Ethereum, according to some, can actually eclipse Bitcoin in terms of market cap one day. I mean, it's the developer's cryptocurrency. Of course, Ethereum's logic and what it does is different than what Bitcoin does in general. I think that the market is large enough to accommodate several players, and Tesla was a good example. I know that you take a look at EV sales, you look at a lot of the traditional car makers that are entering the market too, offering electric vehicles. I think the market is large enough to accommodate, and I honestly don't believe that the central bank digital currencies are going to eat Bitcoin's lunch. I think that if that were to happen, it would be from some kind of other competitor, whether it was a hard fork or whether it was a different cryptocurrency that came from the research and development or the private sector.
Now, as far as what's going on in the markets right now, I've been subscribing to the idea that because the rates jumped up so high so fast, they hit the tech sector and created a pretty good sized correction on things like the QQQ or the SMH or say ARKK. And I was thinking that there's a potential here for these things to have fantastic moves to the upside as we come into the end of the month. If there's a decision made to rebalance back into some of this tech and growth, because 175, 180 on the 10-year is going to stall out there for a little while. Do you see like on the Kathy Wood stuff, that we could be looking at a 1, 2, 3 formation there, and if we blow out 130, it could be really aggressively moving higher?
Yeah, I think so, especially when you look at rates and there has been a topping out of the bond market that we've seen. I think that if you take a look at this chart, I mean, a correction back up higher, a rebound, I think is very likely, especially as we head into the end of the month. But I don't see any reason why the ARK ETF or the QQQ won't recover. I don't see any compelling reason to suggest that the downside that we've seen recently is going to be sustained, especially when you have a topping out of the interest rates and when you have an accommodative Fed and you have a stimulus package coming. I just see that the overall outlook is still bullish, and I expect that to definitely rebound.
Now, two sectors that had very big runs, of which we were very happy about, was energy, XLE, to use an example. And of course, when prices moderate, because at some point you're going to get more supply of the oil because, Russia and Saudi Arabia, as we go into the summer driving season, I would find it hard to believe that they're not going to supply energy. And then, of course, the refineries and all those guys who had trouble in Texas are going to come online. So it wasn't a bad idea to, take some profits on there up at the 54, 52 area and then see where it's going to settle down to. If we look at the XLF, I think that's the financials. They went up tremendously because of the hike in interest rates and, of course, the steepening of the yield curve, which means banks are going to make a ton of money. But if that yield curve is going to stall at 175, 180, is it possible that this rolling over here on the XLF could be more pronounced?
Yeah, I think so. And I was actually really surprised to see bond yields, how quickly they rose. But it seems like they're topping out now and possibly topped out last week. In that case, you could see some headwinds in the financial sector. Although in general, I think this sector has been able to do fairly well, regardless of the interest rate. But if you take a look at this chart, it clearly shows a clear correlation between the bond market and how it's performed. So I think you're going to definitely see headwinds as the bond market settles down over the next several weeks, possibly into the summer.
Now, our feeling on the gold was that if GDX went down towards 30, that was the place to get in. So how do you feel about the gold mining shares or gold in general? Because GDX, not doing much here today, but it does look like it may have hit the low around that 30 area, maybe go down and retest it for all we know. But it's had a big drop, right?
Mm-hmm.
And again, the printing presses are definitely going in full force. The deficits are going to be through the roof, and the stimulus package plus more stimulus, is all going to be done with borrowed money.
Mm-hmm.
So, do you see any potential in the gold miners down here, 30% off the highs, 33% off the high?
Well, I've seen potential in the gold miners and in gold for a long time now, and I don't know why gold is not at $2,500 an ounce right now. I don't really have the answer. It's one of those things where you take a look at the fundamentals and you take a look at the deficits, as you mentioned, and the stimulus and the monetary policy. And I don't really see a reason why we're not going to see a big year for gold, but it just hasn't happened. So again, how much of that has to do with investors putting their money elsewhere? I'm not sure, but I've been looking for gold and the miners to break out for a long time now from a more fundamental perspective, right?
Yeah. There's a lot of talk that it may be later in the year when it actually gets its legs. The dollar's firmed up here because the interest rates spiked back up. So the dollar's been kind of firm between 88 and 92. And maybe that obviously, and of course, you did have a little bit of a parabolic panic in the gold earlier in the year. Whenever you get a parabolic panic, you're going to probably go through a consolidation pullback phase, which is what we've seen.
Mhm.
But this Ray Dalio from Bridgewater was pretty much issuing an opinion that we are at the end possibly of the debt cycle, and that when we go to do all this refinancing as the year goes on, the Federal Reserve may have to monetize it by printing money or whatever to buy it themselves. And that could be the catalyst for the dollar to roll over. And when that happens, probably that's when the gold would go, right?
Yeah. Well, I think the writing is on the wall for the dollar rollover to happen. It's only a matter of when. And that's a pretty good outlook there by Dalio. And that would definitely play into gold. And again, I've been on that train for a while now, expecting it to happen. But timing is a different question altogether.
Yeah, it's always nicer to buy it at a 33% discount off the high than it is at the high, though, right?
Absolutely.
Yeah, so
Absolutely.
this is the time at least to be investigating it down here. With regards to any other markets that you're kind of looking at?
Those for me are the main ones,
Yeah.
the S&P 500 and the VIX. And for me personally, the going down the crypto and the Bitcoin rabbit hole, as we talked about, and the interplay with gold as well. So that's really been my main focus. It's kind of taken so much of my attention in the past, I would say, 6 months.
Well, let's put the S&P up there because that's the vehicle that you do a lot of your weekly stuff in, correct?
Mhm.
And so basically, if we're looking at the S&P and the VIX, just to figure out a little bit of the methodology, do you kind of look at the weekly and monthly lows, or and try to pick a point underneath the reaction lows, like here you had a low, you saw a low, I guess, in the 30 3,700 area, and you have one around 3,750. I mean, how do you come up with lines in the sand on which you'd like to do your writing against?
Yeah, we do the weekly and monthly snapshots. I think that's the most effective. I mean, we're approaching this as still being in a bull market, and we take a look at the VIX as well. We do a lot of our analysis on the VIX, and we try to see where the VIX is going to go and how that interplays with the S&P 500. Again, overall, our general view has been that it's still in an uptrend, and that kind of informs our overall trading strategy and what I write about. But in general, I still see the S&P as from a macro level trending upwards.
Yeah, and it's got a lot of things going for it. It's got the GDP that's growing, and it's going to have earnings that's growing. And then you've got a lot of millennials coming in the market. And then you got a lot of sideline cash with household incomes or household finances being so flush with money
Yeah.
and then, of course, people do like to continue to buy things that are working. And when they see their account growing in the mailbox, it makes them more confident to take any cash and throw it in there.
Yeah, absolutely. It's there's a lot of sideline money, as you said, and the stimulus is coming. And you mentioned earlier at the start that having money in the bank account is actually a disincentive now, right? I mean, you're going to be essentially watching your money wither away through inflation. So I think that the general narrative is that you put your money to work in the market, and I think that we're seeing it. The S&P is like a snapshot of that. And when it comes to earnings, I mean, we see it all the time when you under you these companies, they give their guidance. The guidance is usually to the downside, and then their actual results are much higher than what their forecasts are. That usually has a positive effect as well.
Yeah.
So I expect earnings to definitely recover from where they were last year, right? Obviously.
The buy the rumor, sell the fact, is something that people say. And we saw in China, they announced a 33% jump in retail sales, 35% jump in manufacturing, yet their FXI went from 55 down to a low of around 48 here, 46, 47. So sometimes the reaction to the good news is not exactly what people think, though, and there's a little bit of a risk of that.
Oh yeah, there's always a risk of the buy the rumor, sell the fact. We've seen it. We've seen it so many times. I think for me, I look at it as a general trend. If investors see that the economy is growing in general, and they see that the Fed is accommodative, and they see earnings are rebounding, I think this is a favorable climate for the market. Obviously, it could still lead to some acute events like some declines on the buy the rumor, sell the fact. But you'd think that on the longer term time scale, that a growing economy, a rebounding GDP would lend well to the market.
Now, as far as the weekly options that you try to work with, obviously you're trying to take advantage of the fact that options that have very little time on them do have, the time decay working against them very, very dramatically because they have very little time on them. Now, the VIX, seems to, if it goes near 30 or 30 or anything above 30, it's unsustainable lately. Anytime we spiked up there, that was like a fabulous time to do the option writing on puts underneath the market because obviously, the premiums are fat and the market's had a big correction. And so you can work with out of the money puts and do fairly well with that. But once we get down near 20 here, which is really a line in the sand that, has not been able to been penetrated very well. You have to be, thinking that the VIX may go the other way because that's what it has been doing every time it comes down to 20. But do you think this time it might be different?
Honestly, I don't believe it'll be different this time, just because of how the VIX has performed over the past year and change. I expect it to hang around the 20 mark, possibly between 20 and 25.
Okay.
Just the way there's so many factors as to why it's remaining elevated. I think that the market hasn't shaken off the post-crisis economy and financial market. Things have changed so dramatically since March of last year that I think that the 20, the 19, that whole area is line in the sand. If we do see a break below that, I don't expect it to be sustainable.
Okay.
Just everything that I've seen so far leads me to believe that the VIX will remain in the 20 to 25 range. And yes, as you mentioned, the 30 level has been unsustainable. I don't expect it to spend any considerable time above that, but 20 is the number to watch. And nothing I've seen over the past year would lead me to suggest to think that the VIX has a sustained decline back to where we saw during the Trump administration, for example. I don't see that happening. Maybe there's more risk factored in the market now. Maybe investors are more weary. Maybe there's more actual risk. Whatever it is, that 20 level has seemed to be pretty sturdy as of late.
Now, as far as the idea that we're going to be stable here and maybe pop up towards 25 a little bit, that would kind of go into the idea that we may get a rally here, but it's not going to be a barn burner.
Yes. Yeah, exactly.
In other words, we're already at 3950. I mean, going to 4,000 is only 50 points away. That's certainly not going to take the VIX to 15.
Yeah, exactly. I don't see that happening. Maybe if you would have asked me, a year and a half ago, I would have told you something completely different. But it seems like the VIX has recalibrated to just a higher range since the pandemic. I mean, we actually saw record highs for the VIX, I think last February or March after this whole thing happened. But it just seems there seems to be a recalibration of risk being factored into the market, and you see that with the VIX, and you've seen it throughout the past 6 months as equities have hit all-time highs. You've seen the VIX still hanging around that 20 level, higher than 20, which is definitely against the narrative that I've seen since I began covering the VIX back in 2015, 2014. So it's definitely been a recalibration since last year.
The other explanation could very well be is that the reopening will be uneven. And when things are uneven, that means you'll get corrections because they're having curfews in Miami at 8 p.m. and they're burning mass in Phoenix, and they're doing all kind. They're they're slowing down the reopening in New Jersey, and these bars and restaurants are packed, and there's always that possibility of that variant sticking its head up. So these are some of the unknowns that could cause the volatility I think that you're thinking about, correct?
Absolutely.
Yeah, not a lineal reopening, but more of a zigzag.
Yeah, I think that's a very, very good way to put it. It definitely seems at the surface, and I'm not an expert on virology. It seems at the surface that perhaps the worst of the pandemic is behind us. If you take a look at, daily new infections and things like that. But obviously, as you mentioned, there are variants. There are so many factors that could actually lead this to go the other way again. So that risk, I think, is always going to be there until we actually get this under control. And I was actually doing some reading on this a little while ago, but it seems like a pandemic typically plays out over the span of 3 to 5 years. So that seems to be the time frame. So perhaps we could be in the zigzag for a while longer until things actually recalibrate, or until we feel that we are out of this, and we do have this under control.
With the weekly options, are you focused more on the credit spreads?
Yeah, so my colleague does most of the weekly options trading, and I know that yeah, that's his main focus on the weeklies. And we're in the most liquid markets, the VIX and the S&P. That's really our main focus when it comes to the options market.
Yeah, because with the put writing, if it's uncovered or naked, that can be extremely problematic if something comes out of left field and you get the VIX spike to 70 or something, you know.
Oh yeah, that risk is always there, right?
Yeah,
It's always there. All we can do is attempt to mitigate the risk, but it's always there. It's always a
yeah,
possibility, and that's what we teach our traders, and what we in our program we always mention at the outset that there's always that kind of risk, and the goal is to try to approach trades from a level-headed perspective, but there's always that risk that things can happen out of left field.
yeah. And yeah, I mean the liquidity in the weeklies is pretty good, isn't it?
No, absolutely, especially on the markets that we're focused on. We focus on the most active and the most liquid markets, as we've been talking about today.
You ever look at what they call unusual option activity to try to get some ideas out of that for other things? Or are you guys pretty much S&P only and weekly only?
Well, I personally don't, but I would like to hear more about that. I've never really factored that in.
Yeah, because sometimes you'll see, companies have unusual option activity, and then sometimes there's a price movement that subsequently happens. I think the Nigerian brothers on TV are pretty famous for kind of looking at that kind of stuff.
Interesting.
With regards to other commodities, do you look at anything like the grains? Because they had a very substantial move this year. Soybeans went from like 8 to almost 15. They're still in the 14s.
I'll tell you, I know nothing about soybeans, and I don't follow the grains, but that actually sounds really interesting.
Yeah, no, it's had a big move.
Yeah.
So that's something as well. Um, and the strategies that you guys are doing, do you ever do anything that would be called like a strangle, or where you do calls above, credit call spreads above and credit put spreads underneath, or do you just try to just work with the trend?
We generally work with the trend. We don't. I mean, we try to keep it simple, and that's the strategy that we use when it comes to selling weekly options. So it's typically a straightforward strategy that we teach in our program.
And you're basically teaching different strategies, and then people go out and do their own thing.
Yeah, exactly. And we
I
also
gotcha.
have, yeah, and we also have trading alerts that my colleague puts together. So he's the one who handles the weekly options accounts and the trades, and we send out signals to our users, and then they can paper trade with us, or they can take that trade as well, and then they can follow up with us to see how we've done. We've done fairly well in this program. We do
Mhm.
publish our results, and yeah, it's building a lot of momentum. There seems to be a lot of people who want to save for retirement using these types of investment strategies.
Yeah, and like I say, for part of a portfolio for appropriate people, it might make some sense. Again, paper trading and getting an idea of what happens during volatility is probably not a bad thing to do, especially if you're new to it. So, if you get the VIX spiking to 30 and you've got a credit put spread on, you get a good idea of what happens to that spread. And then you could look at what your alternatives are as far as, rolling them down or buying it back or whatever you want to do. Do you go over contingent strategies of, rolling the position or things like that?
Absolutely, and that's why we always recommend that paper trading is a good option for
Yeah.
people who are inexperienced. And the good thing is the VIX gives us a lot of use cases and what could happen if things go wrong. So it's one of those markets that you should be monitoring before you jump head first, for sure.
Now, you were talking about weekly options. When you're teaching people, do you ever go over any other time frames, or is it just weekly only?
I know that my colleagues focus mainly on the weeklies, and he has a Sunday trading room where we talk about the week ahead. It's
Right.
mostly focused on the weeklies. Yeah.
Do you have any kind of an idea on how far away from current value you can go and still get a reasonable cash flow on a weekly? Like say you're at the 3,900, 3,950 level. How far underneath can you go and still get a reasonable cash flow?
I wouldn't have that answer because I'm not close to
Doing
the
the
trading
actual,
activity.
yeah,
Yeah, I'm not
right.
close to the trading activity, but that's definitely an important question. That's something that we can definitely consider. I don't know, in your experience, do you have any insights into that?
Well, no, I mean, I would just price them out and
Yeah.
I would be more looking at where the market has been and let the market establish the points, right?
Mhm.
And once the market establishes the points, you get a better idea of where you'd want to be. This is a very long-term graph, but um, in February we hit that low there, and I don't know where that is, about 37 or something. And then we have a 37.50. So those would be two big points to use. And then, obviously, the further out of the money you go and the further out in time you go, the premiums change. And, unless there is something that crashes through those points, which can happen, that would be something to price out. The farther out of the money and the further out in time. And then if you thought that we were an overall uptrend, that would be more of a position trading than a weekly. And that's an alternative to the weekly,
Mhm.
totally different risk profile and totally different strategy. But, there's more than one strategy in the world,
Mhm. Mhm.
you know. At the Trading Gods, what exactly are you doing? More research, Sam?
Yeah, I'm mostly involved in the research side. I cover the markets. We actually have weekly. Uh, I do weekly webinars that really give a recap of the market and try to translate some of the strategies that my colleague puts together. We're doing a lot of research in the market, developing some ebooks and teaching people about the opportunities that are in the VIX market as well as in our retirement day trader program.
Are you doing anything with that? Well, that leverage VIX isn't around anymore, is it?
No, a lot of them have been taken out. A lot of them have ceased over the past few years. I know that we've seen some when we saw that huge crash in the VIX, I think a few years ago, that kind of reoriented the market. But yeah, the leverage one we're not using so much anymore.
Yeah, the VXX, which
Mhm.
is the short-term futures on it, is traded 25 million shares today. So I would say somebody's doing it, right?
Mhm.
And
Yeah,
but
yeah. The VXX is a good short term. If you expect the VIX to rise in the short term, the VXX is definitely a compelling bet.
yeah, it's hitting a 52-week low at 12. So to tell you how the VIX has been going as far as VXX is concerned,
Mhm.
the 52-week high has been 59, and the 52-week low is today at 12.11. So that's giving you a little bit of an idea that volatility is coming out of the market, not going in.
Absolutely. It's we saw the spike coming into the COVID crash, and then we saw a few more spikes after that. But really, since I don't know last summer, we've seen a sustained decline in the VIX. We've seen higher, lower highs, and that's been reflected in the VXX, which is now, I think, approaching, yeah, as you mentioned, in the 12 range right now.
Yeah.
Yep.
And like I say, on the actual VIX, we are slipping under 20 today. I see it in the 19, I think 20 area.
Mhm.
And yeah, there are some who believe that we are going to have a very big rally in stocks here because of, again, the reopening and the huge economic numbers that could be coming and the huge demand, the consumer spending. I was listening to the guy who runs Bank of America, and he was saying that year over year, credit card spending is very much up, and that baby boomer credit card activity is up, and that, what do you call it? Grocery store expenditures seem to be rolling down and the restaurants are rolling up. So, we are starting to see the winds of change blowing here. And if the VIX were to break to 15, which is what some people are thinking, that would add credence to the concept of going to 4,000, 4,200, 4,400 and things like that. Because again, we've never seen a situation where the entire country was locked down and were able to increase their household revenues because they got the wealth effect from if they're in stocks, it went up. They got the wealth effect if their houses went up. They got lower if they refinanced. I think there was 2.6 trillion done in refis. So that's an awful lot of money back in these people's pockets from the standpoint of savings, or some of them are taking cash out, right? So,
Yeah, we've seen the savings rate go up. Yeah, we've seen the savings rate go up also during the pandemic, but
Yeah.
you're definitely right. I think there's going to be a lot of pent-up demand, don't you think, when this thing
Yeah.
finally eases off? I think we're going to see an explosion at the restaurants, at the malls, at this. It's going to be quite an epic recovery, I think, that we're going to see.
Yeah, and this 20 number, has been pretty much it for the last year. So if you start trading under that 20 sustainably, and 1919 is where we are right now, again, and you get these economic numbers, and you get these people taking the masks off and going on with their lives. Again, the earnings are really the one that could surprise people because right now everyone's looking at $1.81 on the S&P earnings, which 20 times $1.81 brings you at 3,600. If those earnings were to jump to 250, you're looking at 5,000 on the S&P with a 20 to 1 multiplier. And that might not happen next month, but
in that case, the VIX is definitely going lower.
Yeah. And like I say, it seems to be holding on for dear life here because it's, it's like a avalanche of water coming through called the reopening and the consumer spending. And that's one of the reasons why these interest rates spiked up, because they're normalizing. It's not normal to have a GDP at 6% and have the 10-year at a 0.5%. You know what I mean? So the question is I guess, will that interest rate normalize to 2 and 2.5% on the 10-year? And is that going to be even enough to slow down this consumer onslaught? That's a big question, right?
Yeah. And then I think in the short term, the consumer onslaught is coming. It all depends on when we can actually put this thing behind us. And I guess that's something that we should all be monitoring. And I think that investors are monitoring it pretty closely to see, when things can actually return to the way they were.
Do you ever look at any of the international markets? Because some people are saying, by July 4th, we're going to be out and about. And by Labor Day, Europe will be out and about. And by Christmas, the rest of the world will be out and about. So with this kind of a consumer buying, we know how many people how many people export stuff for us to buy, all those, emerging markets and Europe and Asia. And so do you see a situation where our market may move up first, but those emerging markets and European markets, which are much lower valuations than ours, could have a really big run up later in the year?
Yeah, I think so. I think that the U.S. is often the leader, and I think that if we see a similar opening up in other parts of the world, perhaps in places where they're just generally more restrictive, that can definitely play into it. 2021 seems to be that in between year where we seems to be coming out of it, but we're still concerned. And if the trend continues, I think that we can expect an even bigger second half of the year.
With regards to the auto industry, that is supposed to be a big beneficiary of the reopening. It already has been because a lot of people got new cars, and with the financing rates this low, I mean, it doesn't cost very much to get a car. And the people have money now to spend on a monthly expense like that. Some people were talking about the price of platinum might be interesting in the next months ahead because it was trading at $1,000 discount to gold, and now it's only about $500 or so. So the discount is coming in, and that these catalytic converters, which are used in the automotive industry, could put a demand on platinum, not unlike they put a demand on copper with the building supplies. And that could cause the platinum prices to rise. Have you been looking anything at platinum, or what do you think?
Honestly, I haven't been following platinum, but that actually makes a lot of sense. That sounds really interesting. I typically haven't been following it. It's mostly on the gold and silver that I follow.
Yeah, sometimes like a palladium can outdo all of them, and nobody watches it. You know what I mean?
Mhm, mhm.
But no, the platinum story that I've been reading sounded interesting from the stand, and it's not the thickest market in the world. So if they did have a demand rush, it could. We saw the gold to silver ratio go over 100, and obviously that was a time to buy gold, buy silver, and sell gold because that ratio now went into the 60s from well over 100.
Mm.
And so that was last year, that was the real tip, is to do the silver at 18 or $19, and had a much bigger move than the gold did.
Mm. Mm.
Now, copper prices are another thing. They're saying they need 10 tons of copper to meet the demand that's coming with infrastructure and everything else. And copper already has gone from 250 to 4. And some people are thinking there could be potential in the copper as well with this infrastructure on the horizon, huh?
Yeah. Well, I was expecting that big infrastructure push under the previous administration. We didn't see it, so I think it's still going to come. And in that case, yeah, those commodities are definitely going to benefit.
Yeah, because some people are saying there's kind of a super cycle for the commodities in that, I think if you look after 2000, the dot-com deal, there was a good rally. And if you look at after 09, there's a pretty big rally. So the commodities sometimes have a pretty good time of it right after we come out of a crisis. Maybe it's because we print our way out of these crises. And also, in this case with COVID, maybe the supplies have been tight, and now the demand is going to be really outstripping the supply that's available, huh? That could be a reasoning.
Yeah, absolutely. Absolutely. I think I lost you there. My connection isn't very good, but
Oh.
yeah.
Is there anything else you'd like to go over as far as your research that you've been doing on things that we haven't really touched upon?
No, I think I covered everything. I think I got my Bitcoin fix in. I think that we talked about
Mhm.
the work that we're doing on the VIX and the S&P and the commodities. That for me is a very satisfying hour.
Yeah, no doubt about it. And the key is that the people should be aware of how to get a hold of you and be able to find out more about what you guys are doing and pursue it that way. So again, do you want to explain a little bit about some of the services? Because I was a little unclear. I know you definitely have the information on the weeklies on the S&P, but is there more depth to that? And is there anything else that they should know?
Sure. Sure. So if you go to tradinggods.net, we offer our retirement day trader program, which is focused mostly on selling weekly options, and it's not just in the S&P; it's in the VIX as well, and it's a lot of individual stocks. So essentially, if anyone has goals of generating sustained monthly income, if you're looking to save for retirement, we offer a program that can teach you how to sell weekly options. My colleague wrote that program. It's received very, very good reviews. We were constantly informing our readers about how we're doing, how the market's performing. We have regular webinars that we perform on a weekly basis. TradingGods.net has all of that. If you do join the Retirement Day Trader program, you'll also receive free access to our VIX Trader program, which is something that we developed several years ago. It's pretty much the most comprehensive VIX Trader program on the market. that's included in our retirement day trade program. And you can learn more about that by visiting us at tradinggods.net.
Yeah, I think the key is you have the webinars, which are going to keep people informed and explain things to them so they understand what they're looking at. And then you've got the paper trading that you didn't mention. You have that as well, correct?
Yeah, that's all in the retirement day trader program.
Right.
It's a complete lesson, a complete write-up with videos and instructions on how to sell weekly options. All of that is included. We also have our signal system. Every time we make a trade, our subscribers receive that signal in their email so that they can copy us, they can paper trade with us, or they can actually make the actual trade. All that is included on the website, and it's available at retirement day trader program at tradinggods.net.
Yeah, that's great because, like I say, if you've never done it before, and I'm sure you guys run into a few of that, right, where people don't have experience doing it.
Yeah, it's that a lot of our people we work with are very new to the market, or they have very minimal exposure, and
Yeah.
our program helps kind of get them over that hump.
Well, it's an ability for them to learn the strategies through you guys
Mhm.
and get the data and then put it into paper trading. And then if they're absolutely no good at it for whatever reason, they know before they risk real money. And that,
Absolutely,
and
and
that,
yeah,
you know,
exactly,
yeah.
exactly.
And that makes a lot of sense because a lot of people run down and they go into something, and they if they could have done paper trading before, they would have known A, some of the pitfalls of the strategy, B, that the volatility of the strategy is not for them, and they could have all done all of that with paper trading and not had any of their own actual money at risk. So the beauty is you guys are educating and you're sending out signals and ideas, but you're also letting them use those in a paper trade fashion so that they don't have to lose real money, or they won't have that risk of real money while they're just trying to find out how this thing works. Then once they understand it, and if they want to play ball and they're suitable to do so, then they can play ball.
Absolutely, that's
Yeah.
exactly it.
Yeah. Okay, that's perfect. David, did you want now? Did you definitely tell people the website, right? Tradinggods.net, correct?
Yes, that's correct. Tradinggods.net.
And all of this stuff we were talking about, as far as webinars and data and everything else, and paper trading, is all there.
It's all there. It's all available there.
Okay. Well, that's perfect. Okay, so everyone who's interested to look further into it, that's the way you do it. And again, it was very good talking to you, Sam. I think we covered an awful lot here today, and the markets are going to be very, very exciting, I think, as we come into month end, because it's the end of the first quarter, and there's a lot of things that have changed in the first quarter. Interest rates are a lot different, which means bonds are way down in price. So maybe people will buy some bonds because they're cheap and they have to rebalance. We saw big moves in energy and banks, and maybe they're selling out of that and they're rotating back into your Apples and your tech and your semis, because those have dropped in the quarter. So I think the next 2 weeks will be pretty exciting. And if there is rebalancing, some of the dogs of the month could start barking. So at any rate, it's been great to talk to you, Sam. We'll be talking again, of course, and everyone who would like to get more information, tradinggods.net. I am going to turn it back over to David here at the top of the hour. Every week, we have a newsletter, optionprofessor.com, and we also go over all the markets and give you different ideas on what we think, our opinions. And to get that, you simply go to optionprofessor.com and put your email in. And then every week you'll get the free newsletter, and you'll find out the other services and things that we offer as well. So that's optionprofessor.com for that. Okay, I'm going to swing it back to David here near the top of the hour. And again, Sam, great to be with you, and look forward to talking to you again.
Thanks a lot. Appreciate it.
All right, thanks, guys. Yeah, you covered a lot of good info today. So just a quick reminder for everyone, be sure to subscribe to Timing Research on YouTube or your favorite podcast app. And you can also just go to TimingResearch.com to get access to the archive of this show as soon as I can get it posted, as well as any of the past shows and reports. They're all there on the site. So just want to thank my guests again for today, Sam Bourgi of TradingGods.net and the Option Professor of OptionProfessor.com. Thanks, everyone.
Thanks, David.
Thank you.